What's driving the bond market? Welcome to Real Vision Daily Briefing. It's Monday, October 23, 2023. I'm Ash Bennington, joined today by Christophe Ollari, founder of Ollari Consulting. A quick note before we get started to our Real Vision members, we have rolled out our new Real Vision 2.0 platform. So check your email to get on the platform. There's some amazing new features you're going to want to check out. I've been playing around with it for a couple of months, and it's really cool. Christophe, couldn't be more excited to have you with us here today. You've been looking at these markets. You're a big picture thinker. I was reading your research note earlier in the day. Obviously, historic route in the bond market. Big picture, where are we? How do we think about it? How do we contextualize everything that seems to be happening at this regime change moment?
Thank you, Ash. It's always a pleasure to be on Real Vision. I really think that, after COVID, we tend to think that the measures put in place by the authorities will have the same impact as the ones put in place after GFC. And that, by definition, it will not be inflationary, and we will have the same, low yield, low rates, and suppress risk term premium, and very, very settled markets. I warned at that stage that there was a big difference. The big difference was it was not only a monetary, fiscal, monetary support. It was as well a fiscal, very unprecedented support, which was coupled with the monetary safety net, which makes a big difference because, contrary to post GFC, the cash didn't go only into the, I would say, financial markets and risk assets. It went into the real economy, creating, excess savings on the household, as well, giving the opportunity for the large corporates in the US to front run their funding needs in 2020 and 2021, and making the most, in fact, of the low yield. I think that the most important difference, and you can see it on one of the graphs I send you, it's everything looks like, post GFC at the beginning, and then you have a very big inflection point. What is the big inflection point? It's as the money is going into the real economy, the velocity of M2 is picking up, which means that the real economy is benefiting from the safety net delivered by the authorities in the aftermath of COVID. And you see that on this graph that as soon as V is inflecting, in fact, the bond market is getting the message. We have a different setup. If you add on to the mix the fact that COVID and the invasion of Ukraine by Russia also just impaired globalization, destroy the supply demand, the need for the Western democracies to reshuffle their supply chain. I've insisted a lot on the reshoring, so being sure that your network and your suppliers are getting closer to your country, based on suppliers that you can trust. So that now you need friends as a suppliers, and this has a cost as well. So in fact, we shifted to remember after GFC, the monetary support has been used by the government to deleverage. Like each single press conference from Mario Draghi was about, please guys, just make the most of our low yields to implement, I would say, a big push, fiscal push. What Germany did, for example, they went from 2014 to 2019 from a budget deficit of 3% of the GDP to a surplus. And instead of using, the low yield to extend the duration of the debt and to put in place ambitious fiscal measures, they deleverage. And what are they doing now? In fact, they're releveraging. They are expanding their deficits with a yield at 3% in Germany. So I think that what is very important, I think the fiscal change is not a blip. I think it would be, it would persist in the mid and the long term for many reasons. First of all, we spent months after COVID telling all the voters that deficit don't matter anymore. We can expand the deficit. It's not a problem. That's why you don't have the Ricardian imbalance, unfolding at the moment. What is the Ricardian ambivalence? It's when your household, a consumer, at one stage, increasing deficit become counterproductive because the consumer think about the future tax rise. At the moment, nobody thinks about that for one reason. Everybody has said during 1 year, deficit don't matter.
Right.
So I think that the consumers will expect more fiscal largesse for longer. Then you have the reshoring. So really inventing your supplier network that will have an impact on the fiscal on the deficit. Obviously, rearming in a world which is extremely antagonistic, and the energy transition, which is as well will have a cost.
Christophe, I want to show some of these points visually to our audience because what you're talking about here is just so important. Over the weekend, I was tweeting about the deficit and the quote that I said was, deficits don't matter at all until they matter very much. And it is this moment that you feel the earth shifting underneath your feet. You have three really great charts here I want to take a look at. First, let's take a look at the Great Escape chart. This is the overview of what's happening in interest rates. Take a look at this. This is U.S. Treasuries. If we can bring that up on screen, Brian. Christophe, what are we seeing here?
We see, in fact, 40 years of secular deflationary dynamic. In fact, where does it start? It starts essentially at the end of the 80s, where you had the Volcker, painful normalization at the beginning of the 80s. And then in 89, you got the fall of the Iron Curtain, which has bring a lot of, cheap labor force in the market. And then you have the acceleration in 2001 with the ambition of China at the WTO. And then you got that very, steady decrease of long-term yield. One reason being, again, post-GFC, only monetary push, which I always believe in that. When you look at the negative interest rate policies, like in Europe and in Japan for 7 years, I think it's deflationary because it supports wrong allocation of capital. It's keep alive production entities that should not be able to produce anymore. So I think those policies were deflationary. And then you've got the inflection point with the very, very brutal, inflection and the breakout of that channel, which is the consequence of the fiscal push post-COVID, and then the election of Biden, and what we call the big inflation dynamic.
Yeah. Christophe, at the very beginning there, you said something very important, which is 40 years. This really is a true regime shift. If you look back on the 10-year Treasury chart, it peaks around 1981 at just shy of 16% or thereabouts. This is something that if you're under 65 or 70 years old and you're working on Wall Street, you've just never seen before, that breakout that we see on the right-hand side of the screen.
Yeah, but it's quite amusing because I was looking at the graph over the weekend when I prepared the presentation, and when I started at Lehman at the end of 1993, we were at 8%, and in fact, the current 5% is essentially the average of the 10 years yield pre-GFC. So my view is what was anomalous? Is it the 5% today, or was it the suppressed yield regime that we had for 10 years? And I think it's one of the big insight of the last 6 months. We are learning, we are rediscovering price discovery. We've been administered the market for 10 years. Every month, you know that you're going to have a decent purchase of bonds from price non-sensitive buyers. They buy. So in fact, we talk a lot about the buy the dips on the equity market and the put of the Fed on the equity market. I think the real put was not on the equity market, it was on the bond market, because you know that it was insensitive buyers present every day. So I don't think that we're going to have an auction which is about to fail. I don't think that we'll have, collapsing of the US government debt. I just think that we are in that dynamic where you've got more supply and the structure of the demand has changed. China is not buyer as much as before. In fact, in August, it was the biggest drop of the Treasuries holding in 10 years, which has nothing to do with the geopolitical tension. It's just because August was a big pressures on the yuan. So China had to sell US dollar assets to have dollar to sell and to support the yuan. You have and you have the Fed, which is out of the picture, and so I think that we are in the middle of that. Yeah, rediscovering price discovery. I think it's very important. It's
right. Rediscovering price discovery. That might be something to copyright. Maybe I should get it as my first tattoo. Christophe, let's take a look at the next chart. This is just a little bit of a zoom in here on the prior chart. But the caption, I'm not sure if our audience can read it on screen. It says, worst bonds drawdown on record, on track to print a third consecutive year of negative returns. Price obviously moving inversely to yield.
Yeah, it's we never had 3 years in a row of 3 consecutive years of negative returns on the bond market. So that will be the first occurrence, because I don't see the bond market recovering the losses in the last 2 months of the year, which has a big implication. Sorry, the bond market has been the anchor, the pillar of any diversified portfolio. You know that it was bringing stability in your portfolio. It was a proper safe haven. And what has been remarkable over the last, I would say, 6 months, the bond market is bringing instability, which is not supposed to happen with your safe haven. And this is a note I sent to clients last week. It's what has been very difficult since the escalation of the geopolitical tension in the Middle East. Where do you hide? What is your hedge? The yen is not a hedge anymore, because the yen is impacted by the monetary policy of the BOJ, and it has become not. It can't be a hedge because it's the easy way to express a safe carry trade for the time being.
Yeah.
SOFR and bonds didn't fulfill their usual safe haven role for one reason. It's hot data and the Fed keeping alive the higher for longer narrative. So then, therefore you have 3 edges, which is 4 in fact. Gold, obviously, crude, and you have VIX, but it's a bit complicated, because not complicated, but you need to have your timing extremely precise. And then you have cash, and obviously there's Swiss franc, and then you have cash. Cash has become. Do you remember when Ray Dalio was telling everyone that cash was trash? Cash was trash, but cash is king now. You are paid 5% to have no risk. Right. It's a no-brainer.
Well, it's so interesting because a lot of people who obviously do not follow these markets as closely as you do found that out with their 60-40 portfolios when they were getting whacked on both sides of it. But you mentioned something important, which is the third chart in this series, which is all about term premia. Talk a little bit about what we're seeing here on this third chart, Christophe.
First of all, it's what is the whole structure of the 60-40? It's your overloading in the asset which has a low volatility. In fact, the realized volatility of the TLT in October and September has been much higher, 12 points higher than the realized volatility of the S&P, which is, it's a absolutely unseen. What has been as well the pillar of the 60/40, it's the positive correlation between the S&P and the US yield. So it's a proper hedge. Now we are at the most extreme negative correlation between the S&P and the yield in the US. So to go back to the term premium, it's the risk premium. The term premium is what is showing we are exploding for one reason. The market is concerned not only by the deficit of the US government. So the question is, if there is a problem, do we have a US government able to put in place the necessary measures? And in fact, it sounds like a joke, but we see that the election of the successor of McCarthy shows that in DC you can question: is there a structure enabling a quick answer if we need to sort out accelerated deficits or big issues about the future of the fiscal outlook in the US. And I think that when Fitch downgraded the rating of the US, they insist on the deficit, but they put the focus on the US government. And I think this is the biggest issue.
Christophe, as you might imagine, here at Real Vision, we're covering this from many different angles on the platform, especially. And I want you to take a look at a conversation between Roger Hurst and Michael Nicoletos. This is called "Is the Market Overlooking a Hard Landing?" Obviously talking about some of the challenges that you see on the horizon. This is a conversation that aired last week on Real Vision's Plus tier. Let's take a look at this conversation.
If we see a correction in China, it's not nothing. It's something, and we need to pay attention. So this is what I would pay attention to right now. And I think looking at these things is very important in terms of how you invest in the coming years. And having said that, and I've been wrong because I've been buying US Treasuries, 2-year bonds since the beginning of the year. Actually, I bought cash, I didn't buy future, but my argument was, I don't know where equities are going, but I'm being paid 4 and 5% to wait. So I haven't seen that for 20 years. So I might as well get 5% and wait until I figure out what happens in the world. And if there is a scare, then bonds will rally, equities will fall, and then you can shift your money into equities if that's the case. So again, I don't want to stay, I'm not sure what's happening, but I think liquidity drives markets. And this is the reason, because the reason that markets haven't corrected. Everyone thinks that liquidity is drying up, but the policies that the central banks have put in place in terms of getting the liquidity from the banks as collateral and giving liquidity in different forms has kept liquidity at a much higher level than people think.
Christophe, Michael Nicoletos making some points there, very much congruent with what you're saying, particularly when he said, so he hasn't seen this for 20 years. I might as well get paid 5% and wait it out until I figure out what's going to happen next in the world. Precisely to your point about this question of money on the sidelines, while the market anticipates and attempts to understand the regime shift where we head next.
Yes, and it's when you had some questions about the medium-term outlook post GFC, you were not rewarded to be patient because your cash was earning zero. So you were incentivized to take risk, obviously. But now it's look at the spread between the 1-month stable yield and the dividend yield of the S&P. We are at 15 years extreme. I just when clients ask me what is your strongest trade ID for the next 6 months, I was like, I'm going to look stupid, but buy 1 month stable or 2 months stable. It's if you don't have view, if it's too volatile, if it's the visibility is not good enough, which is a consequence of the central bank who are not giving the usual forward rate guidance, which was a pillar of their communication for 15 years. You're paid to be patient. So be patient and be paid.
Yeah, what a strange regime shift from where we were, call it 2 years ago. dramatically different point. Here's a question that I just wanted to get to because so many people have expressed this to me on Twitter. It's something that's been out there in the conversation. It comes to us from TrillionX Macro from YouTube. The question is, Christophe, with the start of a second proxy war, at which level on the US 10-year yield do you see the Fed starting a YCC policy to stop the bond vigilantes? First, we should probably explain a little bit about what he's talking about here to the novices, because this is such an important point. TrillionX is talking about yield curve control, this idea that the Fed might lose control of the longer end of the curve, increasing the rate at which the U.S. government must finance its debt and needing to put a lid on it. This would be the first time since World War II. If that were to happen again, it would be a historic shift.
I will just take a step back, and I would just, have I think that my strong conviction is that the low yield, low inflation volatility of the last 30 years is over. So I think that we are entering into a higher yield regime for the foreseeable future. So I think that we're going to go back to 2% on a sustainable manner on the US CPI. No, I think that 3% would likely be the new floor. So higher new regime in terms of higher rate regime in the future. At the same time, what I'm massively convinced, it's the economy, the portfolio structure, the financial world is not calibrated for 5% yield. And we talk a lot about R star, the equilibrium rate. I think we don't speak enough about R double star, which is the financial stability rate. This is the threshold where the Fed hiking campaign is starting to create chaos. I think we are not far away, to be honest, and I think we're going to have more issues in the future. Don't forget that the track record of the Fed is absolutely exceptional. Going from there is no tech bubble in early 2000, to there is no subprime problem early 2007. I remember that in February 2020, Clarida was saying that COVID was not an issue, and I think that higher for longer will have a good place in the track record of the Fed. So it's I think that we are getting there. But yeah, there is certainly more upside pressure first on the long end of the curve. YCC yield curve control. I think that I think it's too early. First of all, I think that 5% again for the generation has been used to 1 or 2%. It's high, but in the grand scheme, it's not. It's the average of pre-GFC.
So we're not there yet at 5%.
No, we're not there yet, because don't forget that there is an option, a first option that we can use before putting the bazooka, because yield curve control is a bazooka. It's the operation twist by Yellen and the US Treasury. So I think that by skewing the upcoming refunding toward the let's say 5 to 7 years part of the curve and not to the long end, she can alleviate the pressure on the long end.
It's Operation Twist goes nuclear, I guess you could say. Hey, listen, Christophe, there's one other chart that I want to show here because I thought it was so important. We've been talking about these historic reversions of cycles, some going back 40 years. We've been talking about a GFC cycle. This is a really important chart. This is the chart that you have, and it's such a striking one, of negative yielding fixed income instruments going from $18 trillion at peak in 2020 back down to essentially zero. I think the number on the lower right-hand corner of that chart is 35 million. I remember when this started ramping up in the wake of the global financial crisis. It was something that all of the wonks in the space were talking about, and here we are watching it all roll off.
And I think I agree with you. For me, it's one of the most ridiculous somewhere chart, because when we were at the peak at 18 trillion, you had high yield in Europe issuing a negative interest rate. And when you think about it, that's absolutely a nonsense. It's anomalous. So that's why I think that these ultra-accommodative monetary policies, negative interest rate policies, has forced investors to go down the quality ladder and to pick up anything to create the zombies, those empty structure that were kept alive by flooding cash into the system. And that's why you went to 83. And I think that when you look at the setup, that's quite healthy, that we are going to something which is more sensible with the economic reality.
Christophe, what have I missed here? We've obviously covered a tremendous amount of ground. One of the things that you mentioned that's mentioned in your note is the impact of what's happening over at the BOJ, the Bank of Japan, in the post-Hideki Kuroda era. This is something that's a little abstract, I think, for people to understand. Tell us what's happening there and why it matters to investors, particularly in the US and Europe.
It's I think that I think it's a very important point indeed, Ash. What has been a big tailwind for the Nasdaq and the US Treasuries, the negative interest rate policy of the BOJ, because you had capital outflows from Japan into the US, especially from the life insurance, Japanese life insurance. If the BOJ, I think it's when the BOJ abandon the yield curve control and go back into a normal monetary policy with low rates but not negative, I think the biggest risk is to see that repatriation from funds that have been invested in dollar asset back into Japan. Talking with lifers in Japan, it's the rule, not the rule, but the thresholds will be around 1% on 10 years and 190 on the 30 years. We are getting there, and that will be interesting because that's going to be a big destabilizing force for the US asset that have benefited from this reallocation from the Japanese investors.
Christophe, such important work as we all try to get our heads around the big picture of what's happening here today, getting out of the noise of the day-to-day news cycle, what we love to do at Real Vision, what you do so well. As we talk about this shift from structural tailwinds to structural headwinds, final thoughts, key takeaways that you'd like to leave our listeners and our viewers with.
About the upcoming month, I think the reality, in my opinion, it's the bond market will remain essentially volatile and pressurized. That will require the Janet Yellen to implement the operation twist. But the big question remains for me: what if the bond market doesn't rally when a recession happens? Because in fact, we are all particularly optimistic. It's recession, we're going to have the same, dynamic, safe haven, and a bull steepening of the curve, but long-term yield, rallying, just collapsing. What if, in fact, the market assumes that the answer to the recession will be essentially fiscal and not monetary? And that's maybe the most important question, because it means that a recession will not necessarily be a good news from the for the long end of the bond market. I don't have the answer because I'm not sure that we can push the deficit, limited way. But I think that maybe the market will punish the long end of the curve initially, and forcing the Fed to implement the yield curve control. I don't think that the yield curve control is a completely out of the blue idea. I think it's a possibility. I would price it at 10% at the time being, but I think
10%. 10% probably.
I think that we're going to have the operation twist, but I feel that if the bond market doesn't react the way it should react to a recession, I think it's going to become a much higher probability. And what I love, which I find super exciting, is having yield curve control in the US when the BOJ abandons the yield curve control. I think it's going to be a big chaos and big cash flows disruption and in fact shift. And we need to be. I think it's not an impossibility.
Christophe, it's always a pleasure when you join us, but especially a pleasure as we seek to contextualize everything that's happening in markets across the world. And Christophe Ollari, thank you so much for joining us.
It's my pleasure. Thank you very much for inviting me.
And thanks so much for watching or listening to Real Vision Daily Briefing. We'll be back tomorrow at 4 p.m. Eastern Time, and we're going to leave you with this very exciting announcement from Raul talking about cool stuff. You're going to like this one. Have a good day, everybody.
Crypto is a very complicated space, and it requires a lot of understanding, not only of the crypto markets, but how it fits into the broader macro landscape. These guys are about the best people to take you through that journey of knowledge.
We'll spend the next few minutes discussing and exploring the things that you should be looking at to make sure you have a better grasp and a handle the drivers that affect crypto.
Knowing how to trade these two is going to really protect your portfolio. The first thing to hear about here is that the risk profile is completely different.
Make sure you're using those tools to your advantage to help you gain an edge in the trading of NFTs.
I think it's an incredibly valuable learning for people to get your experience and your take from applying that traditional investing framework into this wild west of crypto.